So now we're going to talk about the new tax law and what is happening, not happening, and what to do in the short run. Brandon, do you want to lead this off?
Yeah, I think just to mention some key points off the top here is these are still just proposals. It's not a law, so we might talk like it's a law, but it's not quite a law yet. They're still being negotiated. It has came out of the House Ways and Means Committee, has not been passed by the House, has not been voted on by the Senate. President Biden still would have to sign off on this bill, so it could change. We may see something a little bit different, but I think we have a pretty good idea now of where we're headed. It's a little bit more favorable than I think we thought it was going to be compared to some of the proposals. So, just be aware of that. There can be people out there that are selling products, preying on these types of fears, telling you to do things now. But just be cautious. Make sure you're well informed, and you do need to do what people are suggesting. So educate yourself by attending programs like this and making sure you're aware of what's going on. Number 3 here, keep cash to pay your taxes. Taxes are going up. It's kind of inevitable at this point. We spent a large amount of money to try to get through this pandemic, so we're going to have to raise some revenue. So make sure you're planning accordingly to pay these taxes. There's a lot of thresholds that if you cross those thresholds, you're going to be hit with larger taxes. So we want to plan around those thresholds, make sure we're doing things if we can to try to avoid crossing over those threshold boundaries. Number 4, state tax is not going anywhere. It's coming back with a vengeance here. The proposal is now to decrease the exemption in half, effective in 2022. So we'll see what we end up with, but we think there's a good chance that we are going to see a decrease of the exemption. The elimination of some of the planning tools that we use. Valuation discounts might be going away, where you can take a discount on the value of assets that you are transferring, unless it's an active trader business. That's likely going to be gone. Grantor trust, where you can make transactions with a trust without having to pay income tax, and can continue to pay the income taxes on the trust to allow it to go tax-free. That might be coming to an end as well. The good news is, if we get these things done before the effective date of the bill, then they're going to be grandfathered. So we still have some time to do some planning, but we need to get that done as quick as possible. The nice news is they did not go retroactive to the date that it came out of committee, which would have been September 13th. They did say it's going to be effective the date of the enactment of the statute. Number 5, if you have a significant estate, use your exemption now, so when it is decreased, you don't lose it. The current exemption is around $11.7 million per person, and it's scheduled to decrease to around $6 million if this bill passes. So if you don't gift over that $6 million amount, you're going to lose that excess estate tax exemption. We can go through some examples of how that works here in some future slides. Number 6, if you do this before the effective date, you should be okay. There's no mention of a retroactive tax on transfers to trust that might trigger capital gains. That was hanging around and floating in some of the proposals. That's not around anymore, which was nice. Number 7, we can be charitable still. There wasn't any eliminations on charitable transfers. Use of charitable remainder trust, I think, are going to become very popular, where you can place assets under a charitable remainder trust before a sale, and then the charitable remainder trust would actually make the sale. And the benefit there is you can now defer out the income for 15 or more years, or for the rest of your life. The catch is around 10% of that value would have to go to charity, but the benefit is you're stretching income out over a number of years, and maybe you will not cross some of those thresholds that we're going to talk about that would trigger some of the excise and surtaxes. You might consider installment sales to a related party to, again, defer out income over a number of years. There's no prohibition against reporting under the installment method, even if the sale is to a related party. So that's something you might consider. Number 9, try to accelerate income if you can. Tax rates are going up, so if we can recognize the income this year, you might be better off. And number 10, There are some proposals. They didn't appear in any of this legislation that came out, but they might be in a final legislation that is negotiated down to limit the ability to take some deductions. So we want to be ready to try to accelerate those if we can, if that ends up coming about in some of the negotiated legislation. Number 11 here, we talked about just spreading out income to avoid thresholds. Number 12, making sure we're funding these trusts while we can. Consider deferring losses to 22. They're going to be more advantageous to recognize in later years when the tax rate is higher. So you might do some sort of that type of planning. Contributions to donor advised funds, private foundations, all those charitable benefits. You can get the charitable deduction. Those might be useful as well. Grantor clats we're going to talk about, the ability to transfer assets to a charity for a number of years, for a term of years, and then whatever is left in the trust would pass to your descendants. And you can do that without incurring estate or gift taxes. That could be a valuable planning tool that might be eliminated in future years if we're not done prior to this effective date. So we'll talk a little bit about clats as well. Number 15, disclaimer planning. You can use disclaimers to make a gift and then undo it if it doesn't look as favorable once tax laws are changed. So we can talk about the use of disclaimer planning and possibly the use of a lifetime Q-tip election, where you can, in a way, undo a gift by using a Q-tip election. And then 16, there wasn't any mention of removing the SALT limitation for state and local taxes, where you're limited to only deducting $10,000 for state and local taxes. That has been a hot item that's been mentioned a lot, and there has been some discussion of including that into a bill. So, one planning idea might be to defer your payment of those state and local taxes into 2022, knowing that if they're paid in 2022, you'll be able to deduct a larger percentage of those payments. Now, there is some risk involved there. If they don't pass legislation to remove that cap, you've incurred penalties without any benefit. But if they do pass legislation, then you might be in a better position, even if you do incur penalties, to pay those in 2022. So, Alan, any other thoughts from a high level here of what's going on and where we're headed?
No, but let me go ahead and work on my elevator speech, which is what you say to somebody when they ask what's going on in the tax law. And since the vast majority of our clients are calling us, asking us about estate and gift tax planning, I'll answer it this way. We have a bill that came out of the House Ways and Means Committee, which means that the most influential Democratic members of the House of Representatives are on that committee, and all tax legislation has to start with a bill from the House Ways and Means Committee. So they passed the bill. Certainly the bill would pass the House of Representatives. There's enough Democrats in the House of Representatives that this is a realistic legislative initiative. Now, the next question is, will 50 of the senators plus Vice President Harris approve this particular bill? And the answer is absolutely not. There's going to be negotiations back and forth, and there's going to be intense lobbying in Washington, D.C., and a lot of campaign contributions made between now and the next few weeks as the Democrats in the Senate and Joe Manchin look at what they are going to be willing to do. Because there's more Democrats in the House of Representatives, you can assume that things are not going to get worse than what has been proposed here. And for estate tax planning, what has been proposed here is that the exemption, which is presently at $11,700,000 per person and goes up to some extent with inflation, would come to 1/2 of its otherwise applicable level on January 1st, 2022. And that includes the ability to gift. So the good news is that you have until December 31st of this year in order to make that gift, because If you use half of your exemption, so you go to 5,700,000, then next year your exemption will be zero, and it really won't have done you any good to do, or much good to do it a year early. So the question is, are you willing and able to give more than 5,700,000? Because if you give 8,700,000, then next year it'll go to zero, and you will have given 3 million more than, or six, yeah, the three than you, or 2 million more than you otherwise would have. So that's the good news. You have time if this passes. The not so good news is that there's certain things in the estate and gift tax area that you have to do before we call the date of enactment. And the date of enactment will be the day that all three of the governmental agencies, the House has voted on it, yes. The Senate has voted on it, yes. And President Biden has signed it. So how far from now to then is that? I would be shocked if it was done in 3 or 4 weeks. I would not be surprised if it took a month or a month and a half. If it takes much longer than that, it's probably not going to happen this year. So what are they taking away from us on the day of enactment? On the day of enactment, any trust formed after the day of enactment has to be formed as what we call a complex trust, which has to be a separate taxpayer. So the biggest thing they're taking away from our clients is the ability to engage in what we call defective or disregarded trust planning. The inability for me to set up a trust and give it more assets after the date of enactment for the purpose of allowing those assets to grow where I can pay the income tax on the growth. And that is a huge, huge lever. The second thing that they would give, that we would lose beginning on the date of enactment would be the ability to sell entity interests at a discount unless it's attributable to an active business. So we will regularly put a client stock and bond portfolio worth $15 million into an LLC, wait a month, and then have the client sell the 99% non-voting member interest in that LLC for a promissory note that might be for $11 million or $12 million to push $3 or $4 million out of the client's estate. We will not be able to do that after the date of enactment. Now, the good news is that if you do this before the date of enactment, what you have and what you will have done will be grandfathered. So by grandfathered, I mean that trust that you now have that has a lot of assets in it and may owe you money can continue to grow. You can continue to pay the income tax on it. You can continue with your low interest note because you put that in place before the enactment. But you will not be able to gift more to that trust or do more trusts like that. So then let me bring you back. So many of our clients who are watching this, you have a large note owed to you by this defective grantor trust. Yes, you have until December 31st to gift the note to your children, but you only have until the date of enactment to forgive the note or contribute it to that trust that's disregarded for income tax purposes. And when you run the numbers, that's going to be a big thing. So the two things that we have been concentrating on since this came out, besides getting our arms around 886 pages of legislation, is to reach out to clients and say, hey, if you're going to be making a sale or a gift and you want to take a gift discount, it may already be too late for you to place assets into an LLC or family partnership and gift a discounted interest because of something called the Sept transaction doctrine. So Monday morning, based upon some telephone calls that I had Friday and Friday night, and then I'm having today, We're going to be forming LLCs, putting stocks and bonds and real estate into the LLCs, and getting ready to gift or sell 49% ownership interests or non-voting member interests. We're going to wait as long as we can, which may be the day before the date of enactment. We're going to have the clients sign the assignment documents and let us hold them in escrow so we can fill in the date before the date of enactment. We'll know when the Senate approves this, and Brandon and I will then fill in the dates on all these assignments and consider them to be effective. There's nothing wrong with that. You can predate a document and put it in escrow with your lawyer or someone else you trust, like your hairstylist or your psychic, and then have them fill that in, and that's effective. Now, the other thing is there's certainly not time to get a valuation report to find out exactly what your discount is or what your business is worth between now and the day of enactment. Valuation companies are busy, busy, busy. They're busier than roofers after a hurricane. So what we're doing is estimate a value, and we'll put that in the document with an adjustment clause that once a formal valuation is received, the amount will be adjusted or leave the amount blank. So that's really, for most of our viewers here, and bless you if you're a tax return preparer and you're watching this, congratulations on making it through September 15th. Now get ready for October 15th, then year-end planning. Hats off to you. But those are, the main messages. So that's my 2-minute elevator talk, which I guess turned out to be 6 minutes. So I would have flunked that if I had tried to give it in the Dale Carnegie course. But Brandon, what are your thoughts on all that?
Yeah, no, I think you explained it really well, Alan. I think the major point there to take away is, let's get things set up now that can be effective if this does look like it's going to pass. We need to start planning now for that to happen, because you can't do it. You can't come into our office, or probably any attorney that does estate planning at this point, the day before this is going to pass and say, I need to do this. That's not going to be possible. We're all extremely busy right now, so the sooner you can get to us, the more likely the chances are that you can get it done.
Right, and for you lawyers and CPAs out there, think about explaining to clients and potential clients that you probably have time to do a SLAT and a descendants trust and an LLC and a seed capital gift and a sale. But we're going to hold off on the mainstay estate plan. We're going to hold off on updating your revocable trust. We're going to hold off on evaluating your life insurance. However, on the life insurance side, here's some surprises that I don't think the members of the Ways and Means Committee understood that they were doing. And there's 3 things that we use commonly that I don't think they meant to put to death, but they accidentally would with this legislation. The first one is the Qualified Personal Residence Trust, and I'll be showing you a slide very soon on how that works. The second one is the Grantor Retained Annuity Trust. Maybe they did plan to kill that one. And the third one is the Charitable Lead Annuity Trust that you can do during your lifetime. So let me go ahead and do a little bit of show and tell here, because a lot of our attendees have never attended one of our webinars and probably never will again, but don't really have the background on how the federal estate tax works. So this is the Estate View software that I developed with Professor Jerry Hash and my son-in-law, David Archer. We put a lot of time into the software, and it does some things that I've just never seen done before. But what I've done here is I've queued up Underdog and Poly Purebred, and they have a home worth $1 million. They have investments worth $720,000. The investments are growing at 3.53%. They're adding $300,000 a year to their investments every year because they're good savers. and the growth rate of their investments is 8.73%, which is optimistic, but certainly not uncommon. So if you go to the left side of the screen where you can see my inputs, in order to use the software, you just plug in a number or just go up and down. So for example, I can say, well, the current value of their assets is really 8 million, and the growth rate is really only 7.23%. So as you can see here in the middle screen, while I'm changing the variables, the computer is calculating 1, 2, 3, 4, 5, 6 scenarios, 7 scenarios. The first scenario is they both die this year, no planning. Well, they're well under the estate tax exemption. So certainly there's going to be no estate tax with this estate, which is considered modest by a lot of professionals who handle estate tax planning. But if they do no planning at all, and by the way, let's go back up here so I can show you that underdog is 64, and his actuarial date of death is 2037, but we're going to go ahead and let him die in 2033. And then Polly is 62, and she's going to go until 2038. So with no planning here, I click on no planning, and oh my gosh, in 12 years, 8 million has grown to 23 million because they've added 300,000 a year, plus they've got the time value of money going on 6-point-something%. I don't know if that's believable. Let me go ahead and bring the savings rate down to 200,000. Well, they're still at a pretty high net worth. On the second death, if they do no planning, the estate tax will be $9 million. So I think they should do some planning. The first planning they can do is they can set up a trust on the first death that benefits the surviving spouse without being subject to estate tax. That's called a credit shelter trust, also known as a bypass trust. So on the first death, 7.8 million goes to the bypass trust, also known as the B trust, and that's never subject to estate tax. So we've brought the estate tax down now to 6.8 million, but there's still a lot of estate tax. Well, they have cute little puppies that they can give to every year, up to $15,000 per year per puppy. That's $30,000 per puppy for each of Underdog and Polly. So an irrevocable gifting trust could receive up to $8 million in value if they just do gifting every year in dollars. And if they're able to do discounted gifting, which I probably don't think they will be able to, but if they were able to, after the new tax law, then that gifting trust would have 12 million, but they would still have an estate tax of $1.7 million. But let's say that discounting is going away. So the discount there is 0. So now they're with gifting, they're still at 3.5 million. What do they need to do to avoid estate tax? I'm going to skip the life insurance menu here, and I'm going to go to an installment sale. And what Underdog and Polly would do today is set up a slat for Polly. You know, Polly's going to live longer than Underdog, and she doesn't earn as much as Underdog does. So they're pretty comfortable. And Underdog's going to put $240,000 into this slat, spousal limited access trust. And then he's going to put $2,346,000 into an LLC. He's going to wait, and he's going to do that Monday, by the way. And even though it takes his stockbroker a lot of time to move the stocks into the LLC, he's going to sign a nominee agreement, which says that he considers the stocks to be owned by the LLC on Monday when we form the LLC. We're going to use a 35% discount, so he's going to sell a 99% LLC member interest to the spousal limited access trust slat for a note of $1.5 million, bearing interest at 2%. So really, what have we done here? We've taken $2.3 million of their assets, and we've put them into a trust arrangement which converted them to $1.5 million in assets, they're going to pay the income tax on the income for all the years in the future up through Underdog's death. And those assets are going to grow at 7%, but Underdog's rate of return is only going to be 2%. And all of that is very legitimate and very common. So I click on year one gift installment sale, and that gets their estate tax down to $853,000. So I'm going to need to sell more. How much more? I'm going to need to sell 3 million. Let's see where I go to zero tax. I'm going to need to sell about 3,196,000, and I'm going to need a larger seed capital gift. I'll move the seed capital gift to 500,000, and now I'm at zero estate tax. Now I can stress test that with a timeline, which shows me what would happen each year of death. Now, we have Polly living this long, but what if she lives longer? Will this still work? And it does still work. But if she lives until 2036, then you see that red, that's the estate tax coming back. So if I go back to my trust logistics, you see that estate tax has come back, but I could go ahead and increase the installment sale. So this is why I like the software, because the planner is able to tell you how much you have to do based upon your assumptions, and then you can easily change the assumptions. Now, I'm going to click generate client letter, and now the computer is writing a letter in Word, and there it is. It's already written, and this summarizes it's not in dog language, it's in people language. But this summarizes all the assumptions and the planning. So if you want a copy of this letter, just send me an email to agassman@gassmanpa.com and just put in the RE line, send letter. And we'll send this letter to you, which explains the estate tax system. Brandon, anything you want to add to that?
No, I think estate view is very valuable to just show clients in a pretty easily understandable way, what exactly our plan does and how it works. And then, the other nice thing about it is you can show them, I'm doing this planning. Here's how much you're going to have left. Here's how much you're owed on a note. And here's your estate tax giving all that. So it gives them, how much do I want to contribute? How much do I want to keep? It helps with that analysis as well. So nice tool and, very easy to use.
Okay, so Brandon, do you want to explain the CUPERT for Diane and Bob? Diane and Bob called me yesterday and said, we've known you many years and we love you and we're finally willing to do a CUPERT. Can you get it done before the date of enactment? So this is the Qualified Personal Residence Trust. I put my home or half my home in the CUPERT. I have the right to live in the home rent-free for whatever number of years I choose. The longer the number of years, the better the math. But if I die during the term, it's unwound and doesn't do me any good. After my term of years, maybe that'll be 8 years, Marcia can use the house, or Marcia can benefit from the assets of the CUPERT. It's called a CUPERT slat. And then on death, after the term of years, there's no estate tax on the home. So Brandon, go ahead and can you explain to Diane and Bob how this works? And I don't want to forget to send them a bill for the time that it takes you to do that.
Yeah, so here we have a $2 million home that they want to place into a CUPERT. Bob is age 75, and based upon those calculations, he can gift half of the home, which would be $1 million. But when you're giving half of a home, it's not really worth exactly half. There's a discount associated with that because no one wants to live in just half of a home. So the discount might be 15%. So when we're analyzing how much of their gift tax exemption they're going to use, we can report the transfer at a value of, let's say, $850,000. So 15% discount off of $1 million. There's software available that will help you calculate what use of your exemption that you will use for this, and basically what the the factors is how long is the term and what is your age, and we can calculate what the expected remainder interest will be, and you're considered to have gifted that when you fund the Cupert. So even though we're really transferring $1 million asset into this Cupert, we only, for gift tax purposes, have to report a gift of around $500,000. So you'll fund the Cupert, report this transfer as a gift using $500,000 of your exemption. For 8 years, nothing happens. You can use the home rent-free just like you always have. After the end of 8 years, then you have to start paying rent, and the home is now outside of your estate. That is good for 2 reasons. One, the home's outside of your estate, so you don't have to include that into the value. So there's estate tax savings already. And then number 2, that rent that you're paying is not going to be considered a gift to the trust and further reduces the value of your estate. And the rent amount can be invested into the market, could be used to maintain the home, and all the growth on the rent is also going to be outside of your estate. So very beneficial for the use of the Cupert. So here you can see the first 8 years, as Alan mentioned, if you die during the Cupert term, since you've retained the right to use the residence, it's going to be brought back into your estate. So no harm, no foul if we die within 8 years. But after eight years, in the 9th year here, you can see the home has grown to $1.3 million, at least half of the home that we've transferred. We start paying rent. We use 8% of the value of the home to calculate this rent. We can invest the rent. We show it invested here. We show how much we have reduced our estate by making this transfer, so $1.4 million, how much gift exemption we used on the initial transfer, and then at the end of the day, how much we have saved by using the Cupert. So after the term, we have saved $371,000 in estate taxes simply by making this transfer of the residence into a trust. After 20 years, the numbers keep getting bigger. Approximately $1.2 million has been saved in estate taxes through the use of a Cupert. The nice thing here about the spreadsheet is all these values are adjustable. So if we say the home is actually worth $2 million, we can just click up and down on the numbers here so we can show the numbers, and that would probably use another $1 million of the exemption, and we can play with the numbers and see where that puts us at. We can change the rent amount, we can change the investments and the growth rates. So nice simple tool here that you can use, and these will be coming to you as part of the handouts that are coming after the presentation. Around an hour after the recording here, you'll get a copy of these spreadsheets that you can use.
Yeah, it's not like a billable hour because it's a real hour. It'll be 60 minutes after we're done. You'll get a copy of this video, which you could send to anyone you don't like. And also the attachments will include these spreadsheets. Will the letter be included as an attachment, Brandon?
We could include the estate view. I don't think we can do it now, but we can send it later. I can get with Kelsey and see if we can send all that out to the attendees as a handout.
Okay, very good. Now, for those of you who are professionals, the one number that this Excel spreadsheet does not give you is the discount number. So you'll have to go to Tiger Tables or Number Cruncher or ZCalc or one of those commercial products and put in the client's age and the 75/20 rate, and then the length of it, the Cupert. So for 8 years, it will be one discount, longer discount for 10 years, longer discount for 12 years. But the interesting thing is, the shorter the period, the more rent you pay, and you may actually come ahead doing 2 years versus 8 or 12 years. And then when you pay the rent, it's disregarded for income tax purposes if you get this done before the applicable enactment date.
Yep. And that had 2 questions on that exact issue. Is the rent taxable when it's paid? So if we're able to set this up before the date of the enactment, which is why this is important, the remainder trust that receives the property after the term of the Cupert can be a defective grantor trust, so disregarded for income tax purposes. So there would be no tax on the rent, and you could continue to pay the income taxes associated with the excess rent that's invested into the market. So very nice benefits there as well after the Cupert term. Now, if we are not able to get this done beforehand, There could be some issues with making the rent taxable. It may not even be possible to do the CUPERT because the gift at the end of the term of whatever's left in the trust might be considered to be a gift as a transfer from a grantor trust that's not grandfathered. So very important to get this done before date of enactment if you're considering the CUPERT.
Now, before we forget, we have one more gift for you, and that is there are two other spreadsheets. This one is for a single person. Now, you don't have to get divorced to use the spreadsheet, because there's also a married person spreadsheet. So you would need other excuses to get divorced. But this shows you on the left the present exemption amount of 11.7, and then what happens if it goes to half in 2026. Now, we're going to do a new spreadsheet Monday showing it going to half tomorrow, or I'm sorry, January 1st. But this is still the same result. And then blue was the Bernie Sanders plan, 3.5 million exemption beginning in 2021. We hope that's not going to happen. But then here's your client, column 6. So here, go ahead and decide what their net worth is to begin with by clicking up and down. So let's say the person has a net worth of 4 million and expects that to grow at 7.25% and is going to save 100,000 a year in present dollars for 7 years and then retire. Well, if the estate tax exemption stays at 11.7 million, nothing to worry about till year 21. Call us in year 20. But the exemption goes in half. There's plenty to worry about, even in 10 years, $482,000 of estate tax liability. So this is just a nice little mechanism, and it's kind of fun to ask a client, well, how much do you save? Because if you could save a little more, you'd have a little more. Hint, hint, stop spending like a bandit. So hope you enjoy those PowerPoints. Brandon, do we want to go through the example on page 45, or what's your pleasure? We have about 18 minutes before we turn it.
I think just going through this simple example here of what is scheduled to happen, because I think there's a lot of confusion about, how does the estate gift tax exemption work? What happens if it's reduced? What happens if I already gifted $11 million and it goes down to 6? Am I somehow penalized for that because I've gifted an additional 5 million? So just walking through here, I think will help, explain this. So we have Miss Jones here. She has a $21 million estate. She makes an $11 million gift using the rest of her exemption because she's already used $700,000 previously. So at the end, she dies next year. The estate tax exemption, she has none remaining because she's used all that. She has a $10 million estate left. She pays $4 million of estate taxes. What happens if she doesn't make that $11 million gift? Well, then she has a reduction of her estate tax exemption next year if this does pass. So her exemption is reduced to $6 million approximately, minus the $700,000 in prior gifts that she's made. So she has 5.3 left. That reduces her estate down to 15.7 million times the 40% estate tax rate. We have estate taxes of approximately 6.2 million. So by making this gift in 2021, using the larger portion of her exemption, she's saved 2.2 approximately in estate taxes. So that shows the importance here of using that exemption while it's available and using the increase. And the benefit here is, even though she's gifted more than the current exemption when she dies, there is no clawback or no penalty for using that increased exemption while you have it. But it is a use it or lose it type deal. So let's look at this example here, where she only makes a gift of $5 million in 2021. So yeah, that reduces her estate now down to 16 million. But when she dies in 2022, you have to look at her exclusion at that point, which would just be the 6 million. You would take away the 6 million of prior gifts already made. And you see there's really no benefit of making that $5 million gift in 2021. She she's in the same boat and has the 2.2 or the $4 million of estate taxes that she would have, just
yeah.
like she didn't make the gift at all.
Yeah, but let's just remind everybody that number one, there will be a benefit if she makes the gift of 5 million, because number one, she'll make a gift that she might not make later if you get her into the right frame of thought. Number two, if she does this before the date of enactment, she can make the gift to an irrevocable trust that can be disregarded for income tax purposes, so she can pay the tax on behalf of the trust. And it also comes to mind that, you know, it's sad when people die, but given the choice between dying this December or next January, so if she needs some sort of a risky procedure and she's been putting it off, or a risky family reunion, then maybe the scales swing a little bit towards going ahead and taking that risk. I wrote an article once called When to Unplug Great Grandpa in Estate Planning Magazine. You can find it if you Google it. And, you know, I wouldn't want to be elderly, wealthy, and in intensive care in December. That's not a good place to be. Give your healthcare power of attorney to somebody other than those who will pay the estate tax when you die, if this exemption is truly going to go down January 1st. Go ahead, Brent.
And, you know, just looking at it solely from if she makes a gift in 2021 and dies in 2022, there may not be a whole lot of value to that gift. But, you know, if she does survive for a longer period of time, there are benefits to making a gift early versus making the gift later. So, you know, and, you know, taking advantage of the valuation discounts and discounting, that's an important analysis as well. So we should include that here when we update our slides for next time.
Yeah. So I want to show this slide 50, because a lot of people on this webinar, this is what you're doing. And for a lot of people, this is what you should be doing. And step one is to take your personally owned or family limited partnership, stock, bonds, and investment real estate, and put it under an LLC. Maybe it's already under an LLC. Maybe it's multiple LLCs, but we put it under an LLC. And we're assuming that it's owned jointly by Underdog and Poly. So the LLC is worth $20 million, and Underdog sets up a spousal limited access trust. Poly sets up a descendants trust. And they wait a little while, a few days after they put the $20 million of assets in the LLC. And Underdog sells a 49.5% non-voting member interest in the LLC to the Spousal Limited Access Trust for Poly's benefit for a $7 million note. Now, he also makes a $7 million seed capital gift to that trust. Poly sells a 49.5% non-voting member interest to the Descendants Trust for the children and grandchildren, if they happen to like their children and grandchildren, and then in exchange for a $7 million note. So now, instead of assets growing at hopefully 7 or 8% or more, they have smaller promissory notes, which if done this month would grow at about 2% per year. So what happens over 20 years or 10 years? In 10 years, it doubles in growth. An asset that grows at 7.2% will double in 10 years. Now there's 40 million in the LLC. Let's say that they dissolve the LLC. About half of the 40 million goes to the spousal trust. It pays the note of 7 million. It's left with 13 million. About half of the assets go to the Descendants Trust. It pays the note of 7 million. It's left with 13 million. So these trusts now have $26 million worth of assets that would have been subject to federal estate tax. Now, notice that Poly and Underdog used very little of their annual exemption amount, and they were owed these notes. And even if they don't forgive the notes, this may handle their estate tax issue. But their bigger question will be, Now I have this note. Should I forgive the note or should I keep it in place? And that can be a difficult question because $10 million is not what it used to be. You're trying to get your estate down below 10 million for a married couple. So we could use something called a self-canceling installment note, which would pay a much higher interest rate, but the note would cancel on death. And keep in mind that Polly can get benefits from this trust to pay for her half of the living expenses until it's exhausted. And if the descendants trust is set up in an asset protection jurisdiction like Nevada, and things go badly, Underdog can get, and Polly both can get access to the descendants trust. So, if you have assets growing in value and they're in your name or in a family partnership, it doesn't work in a pension or an IRA. Those take different types of strategies, but that's really where this door may be closing. So Brandon, where are our income tax slides?
Yeah, so they're on down, I think, starting on slide 75 is where we get into income taxes.
Okay, so you want to walk us through the income tax law, and then everyone will be asleep and we'll end.
Yeah, so the major changes here of the income tax law is an adjustment of rate brackets is number one. They are reintroducing the 39.6 as the highest income tax rate, and they're also compressing some of the tax rates as well. So if you're in the 32, 35, or 37% bracket this year, you can see how those are going to change in 2022 if this does pass. So shorter thresholds for those brackets, and you get there at a little bit higher or a little bit less of an income level with respect to the 35% bracket, and also that top bracket now applies at 450,000 versus 628,000. Similar changes for the single filers here, and then the trust and estate brackets didn't change too much. They're just really going to adjust with inflation, but have the 39.6 as the highest rate bracket. Couple other things that might change here is that we are going to have a 25% capital gains rate if this does pass. So those that are in the highest bracket, it's going to go from 20 to 25%. And guess what? That if this does pass, it's already in effect. This was effective September 13th, 2021. So if you have any sell after that date, if you receive dividends after that date, you're going to be subject to that 25% rate. There is one exception there, that if you had a gain or loss that was incurred prior to September 13th, so maybe you made a sell of your business September 1, and you're reporting that under an installment sell method where you're getting income as it's paid, because that sell originated prior to that date, you can still pay the 20% rate. It does have to be a written contract. It does have to be in place prior to that date. So that is one small exception to this new 25% rate. The net investment income tax rate, big changes here. This is now not only going to apply to your passive income like it has historically, your interest, your dividends, your capital gains, any passive investment that you have. It's also now going to apply on your business income if you are in excess of $4 million or $500,000 if you're married of taxable income. That's effective starting January 1. So S corporations, now that you have this 3.8% applying to all the S corporation income rather than just a salary that's paid, could be considerations there as to whether or not you want to convert the S corporation to a C corporation or possibly a partnership if you had the S corporation formed prior to a certain date. Big deal for trust as well. That threshold for the net investment income tax starts at just $13,000 of income. So if you have a trust that owns a profitable business, that's going to be an issue. You're probably going to be subject to the 3.8% tax. So just be aware that that is coming down. The new 3% surcharge, if you have adjusted gross income over $5 million or $250 or $2.5 million if you file separately, this is going to apply on adjusted gross income. So that number is calculated before any reduction for the standard deduction or any itemized deductions. So if you have, let's say, $6 million of AGI, you make a $2 million charitable gift, you think I'm in good shape because now I'm below the threshold. Well, remember, AGI is not reduced by charitable contributions. That's below the line for those deductions. So charitable planning is not really going to help here. The only thing that could help is possibly spreading out income over a number of years to avoid crossing these thresholds. I think the big place where this is going to come into play is if you sell a business for a large gain. You might have higher income than expected and you owe this 3% surcharge. So just be aware of this, try to plan around it if we can, stay below that threshold. The other important thing to mention, and I think they're really targeting trust and continuing trust here, is that this surcharge of 3% applies if the trust income is over $100,000. So it brings even more importance to trust planning, year-end planning, making sure we're making distributions out to beneficiaries, because when you have a trust, to the extent the trust distributes income to the beneficiaries, that income is carried out to the beneficiaries and then taxed at their level. So that they wouldn't have the surcharge apply until they get over 5 million. But if it's retained in the trust and not distributed, you might have this surcharge that applies. You have until 65 days after the end of the year to make distributions that can carry out the income of the prior year. So if you have a trust, get with your advisors, making sure we're doing year-end planning to get that income out and distributed from the trust to avoid this surcharge if we can. There's changes in the corporate rate. There is a flat 21% tax now, but the proposals are a more progressive tax system like we had in the past, where we would pay 18% up to 400,000, 21% on up to 5 million, and then 26% would be the highest rate in excess of that $5 million. There's also proposals to limit the Section 199A deduction to a total deduction of $500,000. That's not $500,000 of income, that's actually $500,000 of deduction. So you could have up to, I think, $2.5 million of income multiplied by your 20% deduction, and that gets you the $500,000 limitation there. So you could have your 199A deduction limited in some way. That only applies, though, if you are above $400,000 individually or $500,000 as a married couple. These are all effective for the 2022 tax year. Another big item in these proposals is targeting what they refer to as mega IRAs. IRAs over $10 million in value are going to be subject to some pretty punitive rules, where if you have your balance over $10 million, you can't make any more contributions to that IRA. Also, if to the extent that the balance is over $10 million, 1/2 of that amount has to come out as a minimum distribution. So let's say you have $15 million in your IRA, you now have a required minimum distribution in the next year of $2.5 million that would have to come out of that IRA. Even more punitive, if you're over $20 million, 100% of the balance over $20 million has to come out of the IRA. So if you have $25 million in that IRA, $5 million as a required minimum distribution would have to come out. There's also elimination of what we call the backdoor Roth IRA technique, where you can make a contribution to an IRA, convert it to a Roth to avoid the contribution limits on Roth IRAs. That's not going to be allowed if your income exceeds $400,000 for the year. So that's another good planning point to point out here. If we have a year where we have a loss of income, maybe one year we had a bad year, or we sold a business for a large loss, or have a capital loss carry forward that we could use, and we have a low income level, we could make that Roth conversion in that year. So be aware and make sure we're making appropriate planning steps there. Not a whole lot to mention in the charitable world, other than the potential loss of the grantor charitable lead annuity trust or the grantor CLAT. The other thing to mention here is the fact that a lot of these provisions and the thresholds are applied at the AGI level rather than the taxable income level. So charitable contributions may not help you get below those thresholds to avoid some of these punitive rules that apply on high income earners because of these adjusted gross income levels and charitable deductions being below the line. Few other items just to note here. Section 1202, if you have 1202 stock, which is a C corporation that is that meets certain qualifications, then you can exclude the capital gain on the sale of that stock up to 100%. The proposal here is to limit that to 50% of the gain if your AGI exceeds a certain threshold. Cryptocurrencies, if you have Bitcoin, Ethereum, all those cryptocurrencies, they're now going to be subject to constructive sell and wash sell rules as of January 1. So if you do have a loss position in cryptocurrency, you can sell it and then immediately buy back in, not being subject to the wash sell rules to recognize that loss. So keep that in mind. That's not going to be possible going forward. Some changes in the prohibited transaction rules for IRAs. Historically, if you didn't have 50% or more ownership in a business, your IRA could co-invest in that business with you. That's not going to work anymore if you have more than 10% ownership. So a little bit more restrictions there on IRAs. S corporations conversions, last thing to mention here. If you have an S corporation that was created prior to May 13th, 1996, I'm not sure why that date's relevant, but you can convert that S corporation now tax-free to a partnership. So just a simple one-time ability to do this. So something to look at if we have old S corporations as to whether or not we'd be more advantageous in an S corp or a partnership, because you can do it tax-free when under current law, that would be a deemed liquidation of the S corporation subject to income tax on the conversion to partnership. So a nice benefit here that might be taken advantage of.
Right, because many people are in S corporations instead of partnerships because they want to avoid the Medicare tax and employment taxes. And if that won't make a difference anymore, they'll be better off in partnerships, which are more flexible. So that will be a very interesting time for tax planners. Okay, well, I think we set out to do everything we wanted to do. I know that we did not get to answer all the questions we had. We'll be back, or at least I'll be back next Saturday at 11, and I'll be answering all the questions we didn't answer today and all the questions we get between now and then. You do have our information here. If you have any questions, we enjoy answering questions. Please do send the hard questions to Brandon, the easy questions to me, and look forward to seeing you next Saturday. Let us know anything you're thinking or anything you'd like us to cover. We do really appreciate the feedback, and we hope that you have a fantastic rest of your weekend. Please be kind to lawyers and accountants, whether we deserve it or not. Thank you.